No matter what type of business you're building, don't treat fundraising as the objective. In all likelihood, you're not creating a business in order to raise money. You are raising money as a means to build a business. How many startups and how many founders are just seeking immediately to be able to go out and raise money? I mean, let me tell you this, dilution is very real. As you begin the journey, as you're identifying ways to fundraise, don't make it your ultimate goal.
In this episode, I'm talking to JC Garrett, CEO of Farshore Partners and Dashfire. To date, their dev agency and investment advisory arm has served over 600 startups, and their clients have raised in total $1 billion in financing. We're going to talk about how founders shouldn't see venture capital fundraising as a final end goal, why it's better to focus on 0.25% of a market rather than to go after the entire 3% pie at once, and when is a good time to start spending on outbound digital marketing efforts. We'll also try to figure out the valuations of their most successful exits, and if you can't answer a question, we both take a shot of hot sauce. Wish me luck, Martians. Hope you enjoy this one. Hello, Martians. Welcome back to another episode of Marketing on Mars. Today, we got the CEO of Farshore Partners, JC Garrett, with us. JC, thanks for joining the show.
Yeah, Simon, I'm so excited to be here, man. I've watched a ton of your episodes. I hope I live up to, 34 now? 34 others or something like that have been on the podcast. So I'm excited to keep the trend going for you.
Yeah, I think by the time your episode comes out, it might be closer to 40.
Okay, hey, 40.
I've been taking way too many shots of hot sauce. We'll get there in a few seconds, but I'll give a quick intro to you, JC, and I would just love for you to give an intro, your version of the intro. But essentially, from what I know, JC, we connected a few times prior to this episode, but you're currently the CEO of Farshore Partners, right? And also Dashfire.
Yep.
You do a bunch of other mentoring, advisory stuff as well, but your two main roles right now is Farshore Partners and Dashfire. Farshore Partners essentially is a global product development company, and then Dashfire is like an investment advisor arm as well, where you provide fundings to these eventual startups that you're working with. Right. We'll get into all the details later, but pretty amazing. You guys have worked with 600 plus startups, raised $1 billion. Some of the companies have raised over $1 billion in financing. Startups graduated from Techstars, 500 startups, YC, and a bunch of different other partners that you're working with. Tell us a little bit about, well, first of all, correct me if I made any mistakes there, but tell us a little bit about what you're working on with Farshore and Dashfire.
No, you know this. We're going to put you on the payroll, get you out there pitching for us. Farshore is a global product development company. That means we don't have a series of products that we built and sell. We build products for businesses. More specifically, we work almost exclusively now with startups. Sort of from the cocktail napkin stage all the way to your Series B plus funded startups to build software that helps them build better businesses. Sometimes the technology, the product that we're building is very centrally themed to the value of the business. We're creating a literal or figurative digital cure to cancer. Other times they're just using technology to enable their growth, like e-commerce or websites, marketing, digital marketing. As we were going through that journey in the origin, my background is mostly in working with startups as an advisor or consultant. We realized that we should probably be in the cap table of some of these great companies we're building products for. So we launched Dashfire as our companion company to provide that strategic advisory service and that equity support that early stage startups needed to kind of get over the hump and get those future rounds of finance.
I see. And is your background also in product development? Is that how you started Farshore?
Interestingly enough, no. So I actually started my journey working with startups while I was in business school. So I was getting an MBA. And I had actually had all intentions to become a management consultant. I thought I was going to end up at McKinsey for the rest of my life. Always had this profound respect for entrepreneurship and was actually taking some classes out in California and got to meet a couple other entrepreneurs who needed help fundraising. They were starting an organic fish farm in the Philippines, of all ideas. And they had struggled to get funding, and they said, hey, could you help with some financial modeling, maybe help us figure out how to make a pitch deck? I said, sure, I've taken those classes. And so I did, and started working with them, helping them identify what are the right funders, who should they actually reach out to, and then help them actually execute that strategy. They raised a little over $1 million. And I said, why would I go to McKinsey when I could just do this for the rest of my life? So I actually come at it from a less technical perspective, but certainly now over the last dozen plus years of working with and building Farshore, I've become a technical strategist, for startups. And while I'm not a coder by trade, certainly understanding the main blocking and tackling of technology so we can apply it correctly to business, so it can drive fundraising, so it can drive growth, so it can drive acquisition. That's kind of my specialty and my focus. But my business partner, one of my business partners, it's his background in technology that really got this whole thing kickstarted on the tech side.
I see. So it's very interesting. So if you can think about it from a holistic kind of 1,000-foot level, you guys provide these development services to startups. So you see them at an early stage, and then as you're growing with the startup, they might be raising money. Now you got an arm that helps raise money.
Yep.
And then my understanding is you also have an arm that invests. Dashfire also invests if needed. Dashfire will also invest money into the startups as well, right? So you also got like a VC arm kind of as well.
Yeah, absolutely.
Right? Is that how it works?
Yes, you're spot on. So when you work with Farshore and Dashfire, you're able to kind of pick and choose the pieces that fit your need the most. So starting off with basic product development into kind of scaling that product for millions and hundreds of millions of customers. Then we've got the strategic advisory piece up and kind of build and execute your marketing, your fundraising, your operational strategies. And then, yes, we do actually participate on the equity side as well. We were the first and certainly the first kind of dev agency to start offering what most call sweat equity investment. We call it synthetic investment because we thought that sounded cooler than sweat equity investment all those years ago. Right. Thankfully, we've had a lot of success with the fund. So, we did not go out and raise money from LPs or limited partners to kind of reinvest their capital. We started off just doing sweat equity. Now, a dozen plus years later, we've had a lot of successful exits under our belts. So now we've got that capital deployment option as well. So there's a lot of different ways that we intersect with the startups that we work with. It's not a one-size-fits-all solution. Some people just come to Farshore looking for competent, reliable product development support. Other people come for the advisory piece. Some people just for the equity piece. Ideally, we want to offer that full suite if it's something that would be impactful.
Everything. Okay, cool. Well, before we get any further into everything, let's do the tradition on the show. We usually start off with a shot of hot sauce, and then at any point during the interview, if you cannot answer a question, because we want to know all the secrets of marketing, we're going to be taking a shot of hot sauce. So first, what do you have for us today? What hot sauce do you have for us today?
So I'm a big hot sauce aficionado, and I actually went with something more mild, not because my palate can't take it, but in Chicago, where I'm based out of, Cholula hot sauce is on every table at every restaurant. I don't care if you're going to an ice cream parlor or a burger shop. So I'm going to represent Chicago brand and go with Cholula.
Represent. Okay. I just came back from Korea, so I got a different type of hot sauce. I don't even want to try to read it. It's purudak sauce is what it's called. It's hot. Super spicy. So yeah, we got to get a translator. All right, I don't have a hot sauce shot, but shot glass, but I have a spoon. So cheers.
Cheers, brother. Tasty. I might have to.
It is kind of tasty.
I might have to avoid a couple questions just to keep this process going. I've been on a lot of podcasts. So I've never ever in my life done this. If you'd gone back to business school and told me this is what I'd be doing, all these shirts are going to sit your crane.
Oh, okay. All right. Now I'm ready. Now I'm ready to go. So tell us a little bit give us some stats behind Farshore. I know you guys you've worked with over 600 startups since the beginning, but let's say on an annual basis, how many startups are you working with in like a cycle of a year?
Yeah, I mean, that's really one of the cool things about what we do on the Farshore side. Kind of how far we can go in the number of startups we work with kind of depends on the stage if they're in with their product. So, in any given year, I would say there's between 50 and 70 startups that we are actively working with. but not all of those companies are at the same stage. A lot of times when we start working with a business, we are the entirety of their technology team, from fractional CTO down to your base level coder tester. And then as time goes on, they start internalizing or insourcing some of that human capital on the IT side. So our role will kind of shift and evolve. I would say 50 to 70 in a given year. We do work with some enterprises, but almost all of those relationships were born out of bigger companies acquiring startups that we helped build as product partners. And they wanted to continue the service relationship after. 50 to 70. And then in a given year, there might be a handful of enterprise organizations that will continue.
I see. Okay. And are there certain industries that you like to focus on? Like, I don't know, SaaS. We got a lot of SaaS companies that come onto our podcast. We also have like health tech and fintech companies. Are there certain industries that you like to focus on?
I'd say from a service and from an investment standpoint, we're pretty sector agnostic because we're such early stage participants, either as a product development partner or an investor advisor. We get to see a lot of different things. Fortunately for us, unfortunately for founders and entrepreneurs, there's not a lot of people who can focus on the stage of business that we work in, that early kind of, from V0 to V2. There are a lot of people on the tail end of product and investment. There are a lot of people who avoid the section that we're in. So no, but I would say healthcare, fintech, ed tech, D2C, we kind of cover the full spectrum, and we've been, more than kind of just kind of indirectly exposed to just about every industry and sector. Even big pharma, big energy. We work with people who are building the new version of the lithium-ion battery. We work with people who are selling socks, really cool socks and affordable socks online. We run the full spectrum.
Is there like one industry that you've seen more of, than others?
Yeah, I would say a lot of the work that we do is on the B2B SaaS side. It's probably not one specific sector. I could say fintech. I could say construction management. I could say food tech, but I would say B2B SaaS is probably a pretty significant staple. Maybe if I were to give it an average, I'd say 70% B2B SaaS, 35% are D2C.
Right. B2B SaaS, but the industry that they're operating in would just be all over the place.
All over the place. Yeah.
Right. And you said very early V1/V2, right? Very early stage. Are they usually pre-rev?
Yeah. So usually either as technology partners or equity holders, we're the first non-founders in the org chart or in the cap table. So if you think of our team and the way we position ourselves, we are a service provider. We're a vendor for startups. We're talking about Farshore, but we're usually the first hires that they are making, certainly on the product side. And same on the equity side. We're the first advisor in, we're the first equity in, we're very, very early stage. And we even go earlier than that. I can name several companies that have literally shown me a cocktail napkin. And upon that rock, we built multiple rounds of a product, multiple rounds of financing, and in some of those cases, you've got acquisition.
Wow. And how does it work? Let's say I'm a startup. I have a SaaS product that I'm looking to build. I'm pretty early stage. I come to you guys, Farshore and Dashfire, the group of companies. How am I billed? What is going to be? What am I giving in return for all the services and expertise that you offer?
Yeah. So we really try to build this company with a high degree of intentionality for startups. When we first started the company 16 years ago, the idea of a dev agency wanting to work with startups was really nuanced. Dev agencies back then were very much $1 million projects with $1 billion brands. And sometimes you would reluctantly, sort of take on some startup work, right? We wanted to build a service model and a revenue model that really reflected and it fit with startup founders. So generally speaking, we come in, we scope out the entirety of the project. We estimate who from our team we need to kind of allocate and carve out to work on those sprints. And then we've got kind of a series of engagement models. We have people who engage with us just straight cash for services. And then we've got other people who still participate in this sweat equity or synthetic investment equity side. And that's still a big mainstay of the work that we do with Farshore, both for traditional companies and then kind of equity companies.
What would be the breakdown? Like, say 60% is cash for services, 40% equity.
Yeah, roughly. I'll be transparent with you. I kind of laugh at my partners all the time. Building a service business at scale, up to hundreds of employees, which we have, now is hard to do. And so, we've seen
not a lot has made it to that level, like 100 plus. Yeah.
Yeah, no, absolutely. I remember the day I got a call from one of our managing directors out of our offices in India, and they told me that a certain employee had left, and I said, I don't even know who that is. And there was a time where there wouldn't be a single employee I wouldn't have met in the interview process, worked with on a daily basis, and then one day you wake up and you're at that scale, and it was exciting, it was scary. Anyway, so as time has gone on, what we've identified is that for us, we really want to be involved in the equity side as often as we can. We don't force it. It's not a requirement. But just to be really selfish, that's where we've seen the most traction and the most transaction. I think in part because of the role that we play on the tech side, in part because of the role that we play on the strategic advisory side and other areas. So we want to try to get to as much equity as we can. So to finally answer your question, I would say the split for us today is much more heavy on the equity side. Probably somewhere to the tune of like 70% equity, 30% of the customers that we work with, 30% of the customers we work with.
Right.
But you have to understand too that some of those early stage companies, right, from like a percentage of services and hours billed, those early stage companies are not consuming as much as some of our later stage cash-based clients. So the answer would be a little bit different, but kind of the roster list, 70% equity, 30% traditional cash for service.
And my understanding is you guys are actually, you're quite large, pretty well known, at least in the space when I talk to some people. And, an agency growing to even past 7 digits is very, very hard. Yeah. In terms of like revenue. You guys do revenue. You guys have revenue because you guys offer cash for services and you have equity. Where are you guys at right now from a revenue standpoint, or even like range or whatever? Anything you can share?
So, we are a privately held company, and I know there are a lot of people out there, especially VCs, who are interested in some of these numbers. So I'm going to give you an answer, but I'm also going to admit that this answer isn't going to satisfy it. So you better get your hot sauce.
Oh,
I know, right? I will give you some numbers that I can give, but it's not going to be enough for what I think you want. So number one, you are correct.
We'll see.
Only 10% of companies ever, any company ever, reaches $1 million in annual revenue. And less than 1% of companies ever reach $10 million annually. And so, we're proud to say that between the cash that we offer, between the equity stakes that we are taking, we are certainly in that 1% category. But to give you a specific number, I'm gonna deter from that and offer to take a shot if that's what.
So okay. Before we take the shot, and I know it's coming. Okay, there you go. The Martians have spoken. Lights are on. So that 1%, that means you're above. Is that 10 million?
Yeah, so less than 1%. So between cash and equity deployed and stakes of equity and value of equity on an annualized basis, we're on that range. We're well within that.
You're above. You're above the $10 million range. All right. Martians have spoken. We got to take a shot of hot sauce. Yes, I'm going to watch. I always forget. I need to get a cup. I need to get a consistent cup. The problem is I've been moving around a lot. So I'm always getting different size spoons, different size shot glasses, and it's difficult to measure.
We got to get you travel. Get your travel glass. That's what you need.
I gotta get on that. Like a branded, Mark and Mars branded one. We'll see. All right, cheers. Oh,
I feel bad. You've got such a hotter hot sauce than I do. I'm trying to really fill it to the brim to make sure I'm riding this train.
It was really hard in the beginning taking shots of hot sauce. I remember the first one I took. I think it was episode 11, and I remember I had to pause for 5 minutes. You can't see it on the full episode, but it was 5 minutes of pause because I had to run downstairs and I had to get 3 glasses of water back and forth. Now it's a lot. I can handle it a little bit easier, but it's still like right there in the mouth.
It's a really unique concept. I love it. I've never heard of something like this before.
Yeah, I wish I didn't think about this idea either. And then I wouldn't be in so much pain. But All right. So you guys are doing really well as an agency. Very few agencies or companies in general make it to that level. So that's amazing. Um, and so you've worked with so many different companies in the SaaS space, also companies also companies that do D2C. What are some major tips that you would give to, let's say, let's start with the B2B SaaS side, or in general B2C SaaS or D2C. What are some tips that you would give to founders right now that have an idea and they want to get started? Let's say this year, 2023. What tips would you give them? Let's start with the number one tip that you would give them so that they don't make that mistake.
Oh gosh, there's a lot. I think one of the things that I would say is this. If you think back to where my journey started working with startups, it was on the fundraising side. I would say, no matter what type of business you're building, don't treat fundraising as the objective. In all likelihood, you're not creating a business in order to raise money. You are raising money as a means to build a business. And, despite that, kind of obvious level of feedback, I can't tell you how many startups and how many founders are just seeking immediately to be able to go out and raise money. Let me tell you, this dilution is very real. When you bring on investors and dilute the shares of your business, and you do that round after round after round, and then now having walked the pathway successfully with so many companies towards acquisition or exit, you start to do some math. You literally get the envelope with the check or the wire transport and kind of pull that over and you start writing some stuff down and you start thinking, gosh, what if I hadn't taken this much money in this round? It's easy to feel like you can give up equity at the early stage because it doesn't really, immediately represent actual value, but it does. So I would just say that as you begin the journey, as you're identifying ways to fundraise, don't make it your ultimate goal. What your real goal is to finance the business. And the one big thing I would say about this is, entrepreneurship is interesting because if you ask people to define it, there's all kinds of different answers. The answer I always give is a quote and a definition by Howard Stevenson. He said that entrepreneurship is the pursuit of opportunities beyond resources controlled. Pursuit of opportunity beyond resources controlled. And when you hear that definition, you hear that word resources, we think money. I don't control money. But that's not the material resource that matters to entrepreneurs. The material resource that matters is time. And the example I always give when I'm pitched and, people talk to me about this is I say, all right, well, I could offer to give you a $5 million check and chances are you could do something. But it's not 100% that you create $1 billion company. Otherwise, you have a $5 million check. But what if I gave you 50 months? What if I guaranteed that for the next 50 months, you could make every mistake, you could learn every lesson, you could read every book, you could try every idea. I think chances are you could do a lot more of 50 months than you can with $5 million. So just understand that when you start raising, number one, it's not the reason you started your business, but also understand number two, that the money side of what you're doing, the capital side of what you're doing is not even the material resource, it's time. So everything that you do needs to be thinking, how do I buy myself more time? Because on a long enough runway, everybody has a greater chance of success. In fact, most startup failures happen because people run out of time.
Yeah, no. And what is money at the end of the day? And a lot of very successful entrepreneurs say this, money just allows you more options because you have more time.
Yep.
So rather than, very good example, I recently have been crunching the numbers personally on a personal level, is very simple thing, but delivery foods. So rather than me going out to go to the grocery store, buy the food and then cook the food and then wash the dishes, I'm paying extra money for Uber Eats or whatever the delivery app you're using locally, and you're paying for that time because you think about all the time that you save. And that's a basic level that everyone can understand. But once you get to the company level, it's everything. Do you invest money in ads? Do you invest money in SEO? Do you invest money into partnerships? Do you invest every single project you decide to take on is time and it's money, but really it comes down to time because you'll never get that 6 month back from testing out this campaign. You can always get another check for $100,000. Not always, but you can probably get it easier, but you can never get that time back. That 6 months is now gone into the ether. You'll never get that time back. Time is a very important resource, and I love that. I love that part. Aside from time and I guess the raising of the money, what would be, like, if you were a founder right now, what would be the second thing that you would want to tell yourself that you're just starting out? And when you're just starting out.
So there's a lot of liabilities. There's a lot of disadvantages that you have being a startup, right? Because a startup is kind of, a company that has the ambition of an enterprise, the vision of an enterprise, but not the resources. Okay? And remember, resources is not just money, it's time, it's manpower, it's everything else. So you're going to pay that cost. Like, you're not going to be able to have the things that an established player in a market has. But you also do gain a couple benefits as being an entrepreneur. And I would say the singularly biggest benefit that you have is the opportunity to focus your market very, very explicitly. It's what I often call problem market fit, not product market fit, right? And it's about drilling down on a single subset of a larger market set that is either overlooked or underserved, so that the big players who are out there are kind of creating these gaps of vision. And rather than going out and trying to get 1% of a watermelon, go out and find 99% of a grape, right? That's how innovation happens. Actually, there's a great article that I would suggest everybody reading. It's kind of the business nerd version of talking about this. It's called The Theory of Disruptive Innovation. So if you've ever asked yourself, why did Netflix beat Blockbuster? Why did Uber beat traditional taxis? Why have all of these small upstarts eventually taken over these larger giants? And the answer is the theory of disruptive innovation. So, the other thing that I would say is that when you're modeling your business, when you're building your business plan, when you're thinking about your go-to-market strategy, there's almost this compelling nature of saying, I want to go after as big of a market as I possibly can. And really what you want to do is you want to go after as narrow of a smaller market as part of a bigger market. Because if you can go out and collect that 99% of a grape and maybe expand that grape and collect another grape, that's when the big players of the market will finally say, whoa, wait a minute, I want that too. And then you've got, obviously positive competition, you've got the opportunity for acquisition, et cetera. So I would just say, don't be afraid to narrow down and focus on a niche of your market and really own that niche, talk to that niche, market to that niche, build products and services and solutions for that niche, not at the exclusion of all others. Not saying if you're not this, go away, but at the particular focus or inclusion of that niche. If you do that, you'll have a lot better chance of success of not only owning that niche, but materialize that into growth and then becoming one of those big players one day that is now overlooking other niches and segments of the market. But you really need to get down to the nitty gritty of a small subset, as small as you possibly can.
Yeah, no, I totally agree. And like we said in the beginning, it ties back to your first point, which is time. When you're a small startup, you don't have time to create different messages and different branding material and different content to target all 5 of your target segments. Let's say you're selling outdoor clothing, like hiking gear. You can make a separate ad or a separate kind of a separate material for females and males and males of over the age of 45 and also the males under the age of 30 and all this. Or you can just focus on one tiny segment, working males between the age of 25 and 30. You can understand where they play. You can understand how they talk and what they appeal to, and you can build material specifically targeting them. And when you're ready, then you start expanding into other areas, right? Start small. And usually these small companies they become targets for large companies for acquisitions, right? And you can speak on this because you've worked with companies that got acquired in the past.
Yeah, I mean, on the general kind of advisor, mentor, guide, and service partner side, dozens and dozens of acquisitions. On the equity holder side, close to, well over a dozen exits, almost 16 exits. You're 100% right. The other thing is, I think entrepreneurs early on especially, are fearful because they want to show really big growth numbers. And listen, to be clear, there's no more important metric than growth. But also understand this. What VCs fund effectively is growth. So here's an example. Almost 72 cents of every venture capital dollar written go to 3 companies, Facebook, Amazon and Google. That's not conjecture. That's a fact. 72 cents of venture capital dollar, the billions and billions of dollars written, go to those three companies. Why? Because VCs fuel growth. VCs fund growth. That's what they want to fund, right? So don't put yourself in a position where you're trying to spend tens or hundreds of thousands of dollars you don't have to market. You should do the sweat equity marketing earlier on, narrow down that niche, be more effective at acquisition, then create that momentum of growth, take that to the VCs, then they'll gladly give you gobs and gobs of money to spend on scaling that acquisition strategy.
That's almost a second. You just mentioned a very key point. 70% of VC dollars go to Facebook and Google to fund growth. And on this point, I want to switch over, because I know you have some opinions on social media, social engine marketing, SEM, and also all that as well. My thoughts are you shouldn't focus on, and we've had many guests say this as well, but I'm curious to hear your thoughts. Don't spend money on advertising and digital marketing and SEM until you're ready, until you've reached product market fit and you've locked down on your key KPIs and everything. Save that for last. Whereas a lot of founders, they make the mistake and they go directly into digital marketing thinking, I want to get sales right away. Let's run ads. And then now you're $10,000 into your campaigns and you made $0 because you haven't focused on the fundamentals. What are your thoughts on advertising right now?
I'm in 100% agreement with you and the rest of your guests. I've done this and worked with thousands of founders, hundreds and hundreds of startups. And I'm telling you, I have never, not once, not a single time seen a company fail because they underspent on digital marketing and advertising early on. Like not one, and then I've seen a lot of failures. I've seen a lot of great attempts and great efforts that ultimately just didn't get there. And some of them don't get off the ground immediately. Some of them get pretty far, but they ultimately come back. And I've never, not once, been able to associate that's happened because you didn't spend enough money on marketing and especially digital marketing and advertising. Inversely, I have seen countless struggle because they artificially inflate the amount of money they want to spend early on. And that produces a problem. And I think your feedback is absolutely correct. You need to understand and dimensionalize your customer acquisition cost before you start making scalable investments in acquiring new customers. I mean, and the way you do that is by talking to your customers. You know, we're talking about advantages of being a startup earlier. There aren't many, but another one is you get to embrace the law of small numbers. Okay. You don't need big numbers to justify decisions. And plus, when you're at small numbers, you can have a more intimate relationship. I mean, I could tell you so many stories. One in particular was a company we worked with from launch to acquisition, a company called Artifact Uprising. They were acquired by Visco, VSCO. And, you know, what those two sisters, those founders did so well was build an authentic relationship with their early adopters to the point where when they had their first 9,000 customers on board, they didn't have 9,000 customers, they had 9,000 fans. And then at that point, they realized, okay, here's how we actually go out and acquire more of those fans. We know who they are, we know how to talk to them, and now we're just going to put more money behind that and scale. And then they eventually scaled to the point where, you know, an acquisition came in that, you know, they couldn't refuse. So that's absolutely the winning strategy. Anytime your impulse before you've reached, let's say, Series A status, anytime your impulse is, I'm going to just arbitrarily spend a bunch more money on PPC or pay-per-click, PPC, SEO, SEM, you need to throttle that back as hard as you can because there's a time and a place for that, but that time and a place is not at that stage.
And especially right now, in the last couple of years, CPC costs are going through the roof right now, right? What are you seeing? You're working with, you know, 50 to 70 different startups in any given year. What are your I guess boots on the ground takes on CPC and ad costs right now? What's happening?
I mean, I don't know. It's hard. It's hard from one standpoint to trust it. I mean, you know, again, you know, Google, Facebook, everybody else, Meta, don't put a hit out on me, but I think it's clear to say that there's a lack of trust, and you're building a partnership. I mean, you're investing a significant amount of money into these groups. It's hard to actually trust, you know, do you know that this click actually happened? Do you know that this was the response? Do you know that this conversion opportunity happened? Because it's so difficult to attribute these conversion events to the actual source point, no matter what data they tell you is in a dashboard. What I've seen, if I'm doing my job effectively, is I'm not seeing many of those numbers at all. Or put differently, the numbers that I am seeing is very isolated and very focused. It's budget-driven campaigns with a specific exhaustion point and a specific seasonality. So, hey, we're targeting this subset, this group. So the numbers that I see, if I'm doing my job correctly, should in no way skew towards what the average market is, because I am trying to advise and guide people towards situational deployment of capital into that space. What precious capital you do have. Don't get me wrong. I actually think, by the way, you are going to see a renaissance from Google and Meta and other players. I think they realize the lack of trust, the lack of transparency, the lack of the ability to actually impact CAC, your customer acquisition cost. I mean, they have no actual ability to do that, and then it's in their best interest to do that. And so I actually think, if I were to predict the future a little bit here, I think over the next 5 to 10 years, you're going to see these companies actually reprioritize it. And what I'm hopeful for is that founders especially are going to find an authentic source partner that can actually help them bring CAC down, dimensionalize CAC, and then scale up their spending correctly. But until that happens, I would, like you, I would avoid it at all costs as best you can. But, again, and the numbers are only going up. It's only getting more competitive. It's only getting harder. And until these platforms, in my opinion, have a more authentic partnership-driven approach, particularly for early-stage companies, I think it's something to avoid altogether.
And a lot of companies are trying to solve for this, and trying to get answers. And it's still hard. I don't think there's one company that has come out and gave the one source of truth. Like, we know what's going on. It's what people deem dark social right now, right? You just can't. So many things that's non-attributable right now. So where are you seeing? What are you seeing works right now? I know a lot of companies right now are focusing on partnerships and community building and content creation. Those seem to be the 3 key buzzwords as they're shifting budget away. Are you seeing things like this? Like, what are you seeing works right now? If people are spending less on ads right now, where are they pushing more of their budget?
Yeah, I would say, at least from a marketing standpoint, certainly spending on content is extremely beneficial. And I think the interesting thing that we're seeing happen is this convergence of, essentially pay-per-click or advertising with influencer marketing, and the conjoining of that with content. Because I think the reason why there's such a natural fit for influencer marketing, especially micro-influencer marketing, is that what these organizations have to do, right, these individuals, these companies, these influencer companies, is they have to produce more content. And they're running out of content.
Right.
Whether you're on TikTok or you're on Instagram or you're on any platform like YouTube, Twitch, you're running out of ideas. You can only come up with so many content ideas. And that's where I think, especially early stage companies, partnering with those groups to actually collaborate and create content together that's also in head. I'm seeing a lot of influence and a lot of focus on that. And also, you're starting to see the geographic barriers break down as well. I've got a company down in Texas right now where, they are a kind of a sustainable fashion brand with kind of an ecosystem play. And they are exclusively working with South American micro influencers. And it's really showing great results. The rate of return is exceptionally high. The cost is exceptionally low. You're creating content. You're creating affiliate relationships. It's kind of a win-win-win for everybody involved. And so that's where I see a lot of focus. But I do think content is critical, especially for startups, right? And let me just also say this, for founders, for early stage companies, you have to be willing to invest in your personal brand. I mean, go and look at how many Twitter followers
100%
Tesla has versus how many Twitter followers Elon Musk has. Go and look at how many Twitter followers Atlantic Airlines has versus Richard Branson, right? So, the other thing that I would say is, in lieu of investing more into, kind of your business marketing outreach, as an entrepreneur in particular, you have to be investing in yourself. You need to be on podcasts. You need to be producing content on Twitter and LinkedIn regularly. You have to build your own personal brand. And the good news is it will not only have a more immediate impact on your marketing and sales for your business, but you can carry that success with you for every stage of any venture you ever run. So if you do want to pursue a career in entrepreneurship, if you want to be a serial entrepreneur, that investment you make into your personal brand will have an immense amount of value.
Oh man, so many gems that you just said in that 1 minute riff. But the one key takeaway is personal branding. I think there was some research that was published recently by KPMG, or I can't remember which organization now. I read a lot of different articles around this, but a leader's personal brand, like a CEO's personal brand, that their LinkedIn page will get 20 to 30 times more impressions than the company page.
For sure.
People want to trust other people. And I actually wrote a post on it. It got about 40,000 impressions. It was my biggest post of the year. And I wrote, B2B is no longer B2B. It's now becoming P2P, more and more P2P, person to person. You might be talking to a business on the other side, but really it's a person that's making the decision on the other side. It's not a business. A business is just an entity. It's a logo. It's a brand. Right. But it's a person that you're dealing with. So 100% thought leadership. And I think for B2B, even more important, right? In your B2B SaaS space, thought leadership is even more important. And I think it's trickling into the CPG, D2C community as well. People want to buy goods from another founder. They want to hear the story of the other founder. Like, that's becoming very important. A lot of frauds happening, scams, right, in the crypto space, and even in the stock market space with like Theranos, right? That huge fraud that happened. People want to trust another human being. They want to actually connect with another human being, and they want to learn and feel like they've done their due diligence on this person before making a decision. So 100% agree with all of that. So you've worked with so many different companies, varying different levels of success, but some have been acquired.
Yep.
What is your top 3 most successful clients so far to date, if you can share this list with us?
Yeah, I have to go through and just think. I can talk about clients that we have, and you can kind of cross correlate with what the success was, but there are a couple that I have to be careful over. I'll just go with some of the most recent ones. A company called Factor 75. They were a weekly meal prep and delivery company. 2 awesome founders started that. And, they went through all of the trials and tribulations of founders, and without sharing too much. I mean, there were health issues with the founders, there were family stuff. And then on top of everything else, growing with the business. And, thankfully they were able to not only journey past that, but even get early acquisition offers, and they had the fortitude to march past that, and ultimately and finally last year accept the acquisition from HelloFresh. So that's a great one.
Wow.
One that I mentioned earlier, Artifact Uprising. It's one of the special stories, and actually the third one I'll share too is similar. Artifact Uprising started by 2 sisters. They wanted to create the Bentley of Shutterfly products, right? So really high end, really high quality printed photo products. People who were not professional photographers, but cared about the picture they took like a professional. And these 2 sisters did some truly amazing, truly unscalable, truly insightful things, not the least of which is, and I can't remember the exact break point, but they literally wrote a handwritten thank you note to every single customer for every single order. And I mean, it was for years, like well past the point that like I didn't know how they did it. And they literally did it themselves. And that's why they created that such a compelling brand to be able to build off of. The reason why they're amazing is they were acquired by Visco, but also they never externally financed the business. And there have been a couple companies now that are similar to that. And when you could reach an acquisition and an exit point and get a velocity like that without actually externally raising venture capital money, maybe you finance through some debt or something like that. But I think there's a tremendous pathway there, and I always want to champion that. And then the third one, similar, is a company called Pressbox, laundry locker service. You could take your laundry, you could have it dry clean, drop it off in this secure locker unit with your mobile app. You can order your requests, get notified, and work with them until their acquisition by Procter & Gamble, and they're now called Tide Cleaners. Another great example, and another company that never really externally financed or sought serious rounds of capital. It's really, really rare that in the startup world you see that full journey without external financing. But yeah, so those are some great examples, but 3 of hundreds, and I'm proud of it. I'll be honest with you. I'll say one more thing. My list of who I'm proud to work with does not just include the people who've exited, even as a shareholder. The reality is that every founder exits. Every single founder exits. We only see
in some shape or form.
Right?
Yeah.
I mean, we only see the LinkedIn post when you get acquired by XYZ company for tens or hundreds or billions of dollars, but everybody exits. And some of the most proud journeys I've been a part of, truly, have been founders that did not get acquired, but they were able to do everything that they possibly could to put the position in a better position to succeed. And it just didn't work out. 90% of startups fail, but that doesn't mean 90% of founders do.
Mm. This might bite me in the butt, but what were some of the valuations for these exits, for these 3 exits? Anything you can share there?
All right, so I can share one, but we're definitely going to take another shot. So just to give you a bit of context, this is a question you get asked a lot. It's not 100% that this is always the case, but if you hear about an acquisition of a company by a publicly traded company and they don't disclose the terms, you can pretty confidently say that it's $200 million or below in cash. Why? Because the SEC, at least in the United States, and there are similar jurisdictions all over the world that require this, if it's a cash purchase of over $200 million, you have to disclose the actual amount. So Factor 75, they can't disclose. I should probably remember this. It's only been a year and a half, but I think it was closer to $300 million was the final ticket price. The other 2, unfortunately, I cannot disclose, so we are going to have to take another shot.
But it is under 250 million, and Pressbox was acquired by P&G.
Yes.
Is that correct?
Yes, that's correct.
P&G, which is a publicly traded company.
Mm-hmm.
So yeah, under $250 million.
All right. Now let me clarify one thing though while you're loading that up. All right. That's in cash. So if there is a stock portion of the deal, that does not count towards this threshold. But anyway.
I see.
So
okay.
if you acquire a company for part cash. All right, let's do it.
Cheers.
Cheers.
Yeah, I'm cautious of time. I think we're nearing the end. Maybe what we'll do is let's just what are a few things that you're working on right now? Because I know as a founder, it's just constantly improving, constantly problem solving, and becoming a better person, a better founder, a better husband, dad, or whatever. What's one thing that you're working on right now in 2023 that you want to improve on?
That I want to improve on, so it's been interesting. My journey working with entrepreneurs started being boots on the ground in the foxhole, and then started building our companies, Farshore and Dashfire, and still had a healthy dose of that. You never got too far away from working day to day, but it's only natural then as you hire hundreds of employees and you've got services and things like that, that there's a distance between you and some of those entrepreneurs. So what's been really important for me is to reinvigorate my way that can actually give back on the front lines of some of these founders. A lot of different ways that I'm doing that. One is through a community I'm running called Founder Up. It's free to join. Basically, it's a community for entrepreneurs who want to commit to working with other founders to develop themselves as founders while they develop great businesses. So we have guest speakers come in, virtual, in person. We've got a digital community that we actually built off of another startup that we work with, Campfire Social. And we're just trying to create an authentic place for founders to come and help other founders through their own journeys, whether it's their personal journey as a founder, the struggles with that, or it could be business. But that's a big thing that I'm focused on is trying to get back into the trenches with founders and find other ways that I can help them develop along their journey, because I have this profound respect for entrepreneurship.
Yeah.
We never get another chance to define what value is professionally, except when we're entrepreneurs. Somebody else tells us. So I want to empower and enable that for other people. And Founder Up is one of the ways that I'm trying to do it, but also what we're doing with Farshore and Dashfire too. And it's some new and exciting things we have coming.
Awesome. Well, if they ever need something to just kick them in the butt, we can introduce them to some hot sauce. I think the Martians are going to be disappointed I didn't balk more in a couple of questions. You're going to have to bring that cycle back around with somebody who's not quite as sharing. Yeah, no, it's good. It means you answered everything, even down to the revenue questions, which is very good. All right, I think we'll end it off here. Fantastic getting you on, JC. Excited to catch up with you later on in the year, hear more about the founder group that you're working on, and maybe some updates from Farshore. But appreciate you coming on. Thank you so much for your time, and we'll reconnect
Sounds
soon.
Great. Thanks so much, Zach.
Hey, I hope you enjoyed that episode. And if you want to learn more about marketing, just
just hit that subscribe button and check out all the other videos we have with CEOs, CMOs, and founders. We post weekly here, so this way you won't miss any future episodes. Also, you can leave me a comment down below on what you think about this episode and also what else I can do or ask to make the show more fun for you. See you later.